Good day, guys. Welcome to this week's weekly wrap from Rand Swiss. We're going to cover, of course, as usual, what happened the week and some ideas going forward. The big news of the week was probably the US Fed minutes came out this week. We saw, it's really kind of like reading the tea leaves in here. The market reads these things and comes to conclusions that aren't absolutely explicitly set out in the minutes. But basically, what the market has taken away is the idea that the Fed is up for a pause. The Fed apparently is indicating that it might be willing to pause after the next couple of rate hikes. This is something that I think that might help the market out. At the same time, there were indications that they might be willing to go further in terms of how high they're willing to get the price up to, also the interest rate up to. So the market, like I said, has taken a bit of comfort from this. It could be due to the fact that we've had multiple weeks in a row that were negative, and so the market is looking for some kind of reason to bounce, and we got that. At the same time, we also had negative GDP numbers coming out. This is the revision of the first quarter numbers. The first reading of that was 1.4% down. There had been hope that it would be reduced to 1.3% down. Unfortunately, we had 1.5% down. That means that the economy is doing a bit worse than had been anticipated. Strangely enough, that's probably good for the market, because what that means is that the Fed is going to have more excuses not to raise rates as aggressively as they wanted. And for those that don't know, basically, when you're given a choice between a stronger stock market, a stronger economy, or low interest rates, generally low interest rates tend to be better for the stock market than a slightly stronger economy. If your interest rates go up by 1%, that changes multiples by 15%. It's a dramatic, change in terms of just how valuable things are in a market. So it's like I said, it's quite an important, a bit of news coming out. Of course, what we need to look at in the next month or so is going to be the reading for the second quarter. Right now, we're expecting over a 1.5% jump up in GDP for the second quarter in the US. That means that basically there's not going to be a recession. Because you need 2 consecutive quarters to have a recession. And also the overall effect for the first half of the year will not be negative. It'll be slightly positive, basically flat, but slightly positive, which would obviously, again, be a sign that the US economy is not quite in as much danger as people had feared. Other news we had out there, we saw oil prices basically rise again. We had a big drawdown overall. There were some, small increases, and I think petroleum was up, but the drawdown in gasoline and other, products were down from the US. That caused oil prices to go up quite substantially. We still have, the situation in the EU where they're looking to ban Russian exports. And there's also been a strange little case where apparently the Americans have seized a tanker with a Russian flag that's carrying Iranian oil in Greece. So there was a tanker carrying Iranian oil going past Greece. The Greeks had usually seized that and impounded that. That was about 2 months ago, or 1.5 months ago. As sanctions were being hit out by the EU. They were thinking that maybe this was covered by the sanctions. It wasn't, but then apparently the vessel had to stay around for some repairs, and now the Americans have seized the vessel and taken the oil and literally put the oil on another vessel and taken it to America. It's almost like high seas piracy, but if you're the biggest country in the world and the authority, that's something you can do. There's nothing much the Iranians can do about it, quite frankly, and I don't think the Russians have any recourse as well. We've also seen gold prices recover a bit. I think that's also feeding in from that Fed number. What's happening right now with the Fed, the chances are that interest rates are not going to rise as much. That means, the other options you have instead of having gold won't give you as much yield. At the same time, if the Fed kind of blinks, if the Fed kind of sticks off the pedal because of a falling economy, that means we're going to see inflation probably stay higher for longer, which is also good for gold. By the way, we did a study this week on gold and looked at the gold price versus inflation, counters over the last little while, and some interesting things popped out. Firstly, over the last few decades, gold has really not covered or really not responded as you would expect to inflation fears. In fact, gold's responsiveness has been quite weak when it comes to inflation fears. There's a couple of reasons for this. Firstly, the inflation fears haven't really been like high inflation. It's usually been like slightly high inflation, like up to 2% or something. And at the same time, we've also seen a number of other instruments out there getting a lot of love from investors. So, for instance, we've seen real estate. Real estate REITs basically getting a lot of attention from investors when inflation is higher. And in fact, if you had to look over the last couple of decades, when inflation fears were rising, you'd probably want to be investing in REITs as opposed to buying gold. But there's a small caveat for that. The caveat is this: when inflation is not moderate, but rather high. When inflation is above the Fed's 2% target. Remember, the last reading we had inflation for the US has been above 8%, and that's been for 2 periods in a row. Well, in that scenario, gold actually becomes, sorry about that, gold becomes much more attractive. So real estate really falls down when there's very high inflation. It becomes, from one of the top, counters you have for, countering inflation or hedging against inflation to basically average, to basically slightly below average in terms of the overall, normal counters, like for instance, minerals and, gold and, bonds and that kind of stuff. Gold goes to virtually the top in a 2% plus environment. It becomes much more responsive. It becomes much more, it was attractive as an investment for investors in higher interest rate environments, so high inflation environments than it does in low inflation environments. Even if inflation expectations are increasing, would be meaning that inflation expectations go from like 0.5 to 1 or 1 to 2%. Gold really doesn't respond as much. When inflation expectations go above 2%, 3%, 4%, gold becomes much more responsive to what's happening out there. And we haven't seen that quite yet, but I think that might be something we're looking at going forward. We might be seeing gold prices recover based on the fact that inflation is probably going to not look as in control as some people have been hoping. Now, look, I'm not going to say inflation is going to be going up much from here. I do expect that probably where we are right now, 8.5%, the second last to last reading, is probably either the peak or close to the peak of inflation for the US. 9+% for the UK, probably close to that peak. What we are saying is that if it goes a little higher, it's not going to stay that much higher for longer. It will come down, but it's not going to come down to the levels that these countries want. The US wants 2%. That's what it wants. It doesn't want 3% or 4%. And I can easily foresee inflation coming to, like, say, 3%, 4% and staying there for a longer period than you would hope for. And what this means actually is quite a big drop down in real wages. So a study came out this week where real wages in the US are down 40%, are down the most they have been in 40 years. So that's a pretty surprising number. And that could explain why we are seeing such dissatisfaction with the Biden administration at the moment. Biden's approval numbers right now are significantly worse, not just worse, significantly worse than some of the stuff we saw for Trump. I mean, that's how bad it is. You may not get that from the media, you may not get it from the news cycle and so on. But polling out there is very clear. Biden is significantly less, popular than Trump is right now. If there was an election held today, Trump would beat Biden, not just in the Electoral College, but by the popular vote. To give you an idea how big that is, in the US, the Democrats has to win by quite a big chunk of the popular vote to have any chance of winning the election, because there's so many states out there where Democrats just sweep the floor. Right now, Trump has a chance of beating a Democratic thing. So you put the top ranking Democrats, you put, for instance, Biden or Kamala Harris, Trump beats them handily in the Electoral College. Even against people like, for instance, Pete Buttigieg or Bernie Sanders, Trump is looking a lot more attractive. And that, I think, is feeding through because we are having these inflation numbers looking so bad, and because people are feeling the pain in their pocketbooks. Because, yes, we have rising wages, but we don't have anywhere near much attractiveness coming through with regards to real wages. And finally, I'd like to point out another bit of risk that's been on the cards. We had Rishi Sunak, which is the Chancellor of the Exchequer in the UK, which is kind of like the Finance Minister of the UK, has come out with what he considers to be a temporary measure to put a 25% tax on profits of gas and oil companies, energy companies, basically, a 25% tax on profits. The thought is that there is too much profits being made in the sector. Something we've heard, for instance, from the US as well, but it's kind of been pushed down. But in the UK, I think this is going to go through, or has gone through. So we are going to see those companies that are based in the UK that produce, energy, produce gas, produce oil, are going to be losing 25% of their super profits. And basically that's going to last as long as the super profits last. So it's not going to be, once off and then it's going to disappear. He says he'll phase that out as profits return to normal. So if you are looking at some of the pricing of some of these international, especially UK-based, energy companies, this has dramatically reduced their potential pricing for, if you value them according to a cash flow basis. Okay, that's it for this week, and I look forward to speaking to you guys again next week. Cheers.